morning. Great to see everybody here. And David, such a nice topic you have today, right? Just as today, interest rates in US reach above 5%. So your topic is going to be the easy one in this conference. So please, thank you. Enlighten us.
Thanks very much. Well, I'll stand up if you don't mind, just sort of try the slides, make sure we're working there. Here we go. So yes, the timing of what we're doing couldn't have been done better, really. What I want to explain to you over the course of the next half hour or so is we've been really in an environment over the last 4 or 5 months where we've been looking at higher for longer yields, and it looks like we're finally reaching the culmination of that, as Leonardo said. Today is the day, the first time we've seen US Treasury yields at 10-year trade above 5% since the July 2007, so before the GFC. So what I want to talk to you about is why we're seeing that come through. Now, part of that story is going to be about why we're still seeing the US economy doing reasonably well against a backdrop where we've seen quite a lot of tightening in monetary policy and some signals of a downturn in the economy that's just not really manifested. So I'll talk to you a little bit about the lags that we're seeing coming through there. Then the macro story about why yields are rising. Part of that is the fact that we haven't seen this recession emerging in the US. And so that's tied in with where the Federal Reserve is going to see the peak in interest rates. But more importantly, we argue, it's talking about the rate cuts that are coming through afterwards. The market had been pricing significant cuts. It no longer is. So now we're seeing rates higher for longer there. But there's also a view that we're seeing longer term rates still being elevated. And this is a talking to the neutral rate being a little bit higher. So there's a clear macro story as to why interest rates are higher at the moment. And I want to go through that. But there are also a couple of technical features that are going through in the market. And the macro story really doesn't explain all of the pickup in US Treasury yields. So what I'll talk about is, firstly, the movement higher in break-even inflation expectations. Not too high, nothing that the Federal Reserve is going to worry about, but higher than we've seen in the last decade. And also the return of term premia. So 2 technical aspects to bond yields which are starting to re-emerge into the market. So that's what we'll start talking about. Then I want to talk about US exceptionalism. This story is really happening from the US side, so it has implications for the rest of the world. I'll give an illustration from the Eurozone side where we're not seeing such strength coming through, and that's really causing some of the pressures coming through from euro-dollar, but the dollar is stronger more generally. And then I want to talk about some of the challenges that the emerging market complex as a whole faces from the higher yields that we're seeing coming through and the stronger dollar. And then talk about really some of the exceptionalism for Mexico. The Mexican economy is not seeing some of those headwinds. It's not to say there aren't some challenges posed by the global economy, but we're really seeing a dynamic economy evolving through Mexico. And I want to talk a little bit about that. So firstly, why have we not seen a downturn? The US Federal Reserve has increased rates by over 500 basis points. Typically and historically, that has led to a downturn in the economy. And some of the traditional metrics that are pointed to recession have been looking that way. The yield curve's been inverted, credit conditions have tightened markedly. We argue that some of the reason that this hasn't led to recession is because of the buffers built into the system through policy that was engaged over the pandemic. Now, primarily that comes through from the household sector. The US government paid the US households significant income support at a time when they just couldn't spend, and that really saw savings push up. So what we argue is that interest rate policy has been sufficient to slow the economy, but it's only slowing through eroding those buffers. And there's a slight analogy on the corporate side as well. Corporates have refinanced significantly over that period as well. So that has delayed certainly the slowdown in the consumer sector. Now, we argue that there is going to be a deceleration in US consumer spending coming through as soon as the 4th quarter. The 3rd quarter in the US looks like it's going to be another very strong quarter. But as we move into Q4 and we see some of the underlying pressures come through, the exhaustion, we think, of these excess savings and the resumption of student debt payments, all of those are going to impact real incomes from a US household perspective, and we think are going to start to slow the economy materially. So that story is part of why we haven't seen a recession, and I'll come back to that. The other side is that investment spending has been stronger than we'd expected. We always thought that the CHIPS Act and the Inflation Reduction Act were things that were going to boost US economic activity. But what we've seen is that coming through a little bit quicker than we expected, and there's pretty strong evidence that we're already seeing strong investment spend coming through there. So that's lifted the outlook for investment more quickly than has been expected. So what that's led to is what we call a desynchronized or an asynchronous slowdown in the US economy. Typically, for a US recession, you need all of the sectors to slow at the same time. And what we've seen is a sort of slowdown by installments, what many US economists refer to as a sort of rolling recession. So in the second half of last year, we saw a material drop in US housing. In the first half of this year, manufacturing and inventory adjusted quite sharply, and only now do we think we're on the cusp of a slowdown in consumer spending. So these slowdowns have been spread out over a period of time, which has meant that the US economy hasn't fallen into recession, and our forecast is that we don't think it will fall into recession, although we do see some softer periods of economic activity still emerging. So that starts to become very important for the rates cycle. The first thing we normally think about when we think about US 10-year yields is what the Federal Reserve is going to do. Where's the peak in rates coming? And it looks very clear to us that we're certainly close to the peak in rates. Our own view is that we're probably at the peak in rates. The Federal Reserve itself suggests that there will be another rate hike on balance by the end of the year. Their last projection showed 12 participants saying they would hike again before the end of the year, 7 saying they wouldn't. We think on balance economic data is going to slow sufficiently. Certainly there are some geopolitical tensions now coming through that should mean the Fed doesn't tighten again. But that's important because if we look at the chart on the left-hand side, you can see that the peak in US Treasury yields typically occurs around the same time as the peak in the Fed funds rate. So if we're seeing the Fed at or near a peak, then we should also be expecting to see US 10-year yields there. But we also argue that the macro story isn't explaining all of that. And certainly when we just think about the peak in the Fed funds rate, it's clear to see why that shouldn't explain the whole 10-year story. Because when we're talking about the peak in the Fed funds rate, we're just talking about the first year of interest rates in a 10-year bond range. So we're only fixing that first point. So just because we have some clarity there, there is an exception here where we could see yields continue to rise. So more importantly is this story, and I think what we've seen over the last 4 months is a transition in the market between, at the start of the summer, markets wondering whether we would see a hard landing, a recession in the US, or a soft landing, whereas actually coming out of the summer, I think the story is more, are we going to see a soft landing or no landing? Well, we discount the no landing scenario. We think there has to be a slowdown in the economy to re-achieve inflation. But we do now think it can be a soft landing. And that difference in view has very different implications for what interest rates are going to do, not this year, but over the next couple of years. So less than 6 months ago, markets were still forecasting rate cuts by the Federal Reserve by the end of this year. And that very clearly isn't going to happen now. But if we look at the chart on the right, we can see the difference between how the Federal Reserve has historically responded with interest rates during a recession. So we've seen very aggressive easing in monetary policy over those periods. And the only in modern times example where the Federal Reserve has seen a soft landing was in the mid-90s. And during that period, they did cut rates by 75 basis points, but then there were increases coming through, and as the chart illustrates, over that period, we actually saw rates basically stable for about 3 years. So there's quite a difference in expectation as to what rates are going to be, not at the peak, but next year and the year after, if we're no longer thinking about recession in the US and we think a soft landing, a slowing in the economy, will be sufficient. And that's exactly what we've seen come through from markets. So the chart on the left illustrates that the top line is where markets have been expecting the peak to be, and that really hasn't changed at all over the last 4 or 5 months. All of the shift has come over the last 4 or 5 months in expectations for where rates will end next year and where they'll end the year after. So we're seeing those rate cuts being faded from markets, and that boosts interest rates. But there's something else going on from a macro perspective as well. The investment story has also started to pick up. Now, as I say, we've already seen some evidence coming through that investment is picking up more quickly. The CHIPS and the IRA Act both led to significant increases in corporate announcements that there was going to be significantly more investment spend come through. And from a very simple economic perspective, that should lift interest rates. So very simple economic models suggest that planned investment is something that drives interest rates higher. It's the reverse of what we saw over the last 10 or 15 years, where the increase in planned savings was an explanation as to why interest rates were so low. So this was Ben Bernanke, the ex-Fed chairman's savings glut. So this investment spend should push interest rates higher. But what we're also seeing is an assessment that the neutral rate, where rates are going to settle, not this year or when the Fed's cut rates a little bit, but where they're going to settle over the bulk of the 10-year period, is starting to rise. And starting to rise from sort of relatively subdued levels over the last 10 or 15 years. And so part of that story is investment spend. Part of that is what investment spend leads to: faster productivity growth, faster trend growth rates from the US. And there are other indicators that are also suggesting that trend levels of interest rates, the neutral rate, could be a little bit higher. So the chart on the left starts to bring all of this together. It's not so much that yields have been lifted by the peak rate expectation, the rate expectation for year one. Rate cuts for year 2 and 3 have been reduced, and there's an expectation that rates from years 4 through 10 are also going to be higher. So there's a very clear macro narrative as to why we're starting to see higher yields emerge. But as I suggested, our view is that that macro narrative doesn't explain the whole movement coming through in yields. So 2 other factors I think are important here. The first is break-even inflation expectations, that component of bond yields that compensates you for the risks of inflation being high. And what we can see in this chart here on the right-hand side, my right-hand side, sorry, your left, is that break-even inflation expectations have lifted. So they're not troublesome. They're no higher than they were during the 2000s, but they are higher than they were during the last 10 years. So that starts to put a little bit of upward pressure back into yields as well. Now, we don't think that's got further to run. Inflation expectations have been well behaved. Markets in general believe the Federal Reserve when it says it's going to remain anchored to 2%. There are some very eminent economists, Nobel laureates no less, that have suggested that the Federal Reserve should change the inflation target. And we just don't think that's A, going to happen, or B, should happen. It shouldn't happen because if we did see the inflation target rise, that would just really increase inflation expectations, increase pay negotiations for next year, and fulfill its own cycle of keeping inflation a little bit higher. There was perhaps a time to consider a higher inflation target, but that time was 10 or 15 years ago when the Federal Reserve was struggling to get the real interest rate low enough. Then there might have been an argument for higher inflation target. But now there's not. And the Federal Reserve has been very clear that that's not going to be the case going further forwards. So we really don't expect to see a material pickup in inflation expectations over and above what we've seen. But it does contribute some of the pickup coming through here. The other story is term premium. Now, term premium is that component of bond yields that rewards investors for locking into returns for a longer period of time. Why take a risk of buying a 10-year bond when you could hold a series of 1 or 2 year bonds? Well, it's historically was because you got a little bit of additional term premium coming through. And that used to be very cyclical. So clearly that compensation didn't need to be as much when you thought you were at the peak of the cycle, as broadly speaking we are now. So we wouldn't expect it to be a large component of bond yields now. But as rates start to fall again over the coming years, we would start to expect to see that come back. So term premium used to be cyclical, but there's a structural component to it as well. Quantitative easing, as used by all of the central banks, was specifically designed to quash term premium. And that's what it did over the last decade. So term premium fell away even with this cyclical story going on. But now as the Federal Reserve is midway through its quantitative tightening process, the unwind of quantitative easing, that term premium is starting to come back to the market. So that combination of factors is providing some technical pickup to yields as well. So what we argue is that yields are rising because of a macro story, a very strong macro story, that The US looks like it's going to avoid recession. The Fed might be near a peak, but it's not going to cut rates soon. And because of the longer term investment that's going on in the US, the longer term interest rate story is likely to be higher as well. That macro story is driving yields, but it's supplemented by an increase in inflation expectations and by the pickup coming through in term premium as well. How does this compare to the rest of the world? Well, this is where the US starts to look a little bit exceptional, and I think this causes some problems. If the whole world was seeing a more resilient economy, if the whole world was seeing this big pickup in investment coming through, then perhaps there wouldn't be too many shocks coming through. But because it looks like this is a very US-centric story, it starts to create some pressures in the global economy. So let's think about, for example, the Eurozone first, another large economy similar in size to the US and a developed economy as well. The outlook for the Eurozone economy is not as encouraging. So Eurozone growth, we think, is likely to contract in the third quarter, albeit by a 0.1 percentage point contraction only. And we don't think the Eurozone is falling into recession, but it is likely to be relatively stagnant. So you compare that to the resilience we've seen in the US economy, and there's a clear difference coming through here. So firstly, the Eurozone economy is not as resilient. Secondly, the investment spend in Eurozone is nowhere near as much or is nowhere near as strong as we've seen coming through in the US. So we can see from the other chart here, the chart on my left, your right, that despite the fact that the Eurozone is going through a multi-year process of repurposing its energy structure, is well on the way to transitioning its economy away from a fossil fuel environment into one that's more consistent with its net zero targets, we're still not seeing the growth in Eurozone investment that we are coming through in the US. Both of those factors are important when it comes to the reassessment that we see come through in Eurozone, and specifically here, German Bund yields. So here, we haven't seen as much of a repricing in the ECB. There is still a view that the ECB is going to cut interest rates across the second half of next year, and that's driven by the relative weakness of the economy. And there isn't so much of a view that the trend rates of European long-term interest rates should be higher because investment's so much stronger, because investment relatively isn't quite as strong as all of that. So the macro argument, if you like, for higher German yields is less. And at the same time, the ECB isn't unwinding quantitative easing just quite as quickly as the Federal Reserve is. It might over the coming couple of quarters, and certainly it's starting to think more about its balance sheet. But at the moment, that isn't the case. So those technical factors that are also pushing US Treasury yields aren't working quite as strongly for German yields. And hence, we can see in the other chart the comparison between US yields and German yields, why US yields are rising so much more quickly than German yields. Now that clearly has an impact on the dollar. So if we just concentrate on the comparison between the US and Europe, what we see is very strong yield differentials starting to come through, and that key difference in longer term interest rate differentials being a driver of US dollar, and that US dollar euro rate really reflecting that interest rate differential over a long period of time. So some of the strength of the US dollar, some of the weakness that we're seeing coming through from the euro at the moment is driven by this interest rate differential. But we can extend that analysis. We don't have to just think about it in comparison to the Eurozone. If we look at the dollar against a broader basket of currencies, using the Bloomberg DXY index, for example, then we can see the same story exists. If we do an interest rate differential story between the US and all of the other economies in the DXY composite, then we see that real yield differential is also important in explaining dollar strength coming through here. So you have two features that are starting to come through. The first is the fact that we're seeing stronger yield growth emerge, and the second is that stronger yield growth, being so US-centric, is also driving the dollar higher. So then let's extend that analysis. What does that mean for emerging markets? Well, historically speaking, the combination of higher US Treasury yields and a higher dollar has been something that's been something of a headwind for the emerging market complex. And we would extend that. You know, if we think that one of the best historical analogies of the current period of interest rates could be the 1990s and the soft landing that was achieved there, well, the 1990s wasn't a great period for the emerging market complex as a whole. distinct problems in local markets here in 1994, and then obviously as we move into the absolute period of the soft landing and the Fed kept rates on hold for successive years, we rolled into the Asian crisis and then the Russian crisis. And all of those were born of the same story. They were higher for longer rates, which meant that as time passed, the average interest rate that those countries bore started to increase, and that increased fiscal stresses. So the historic background is relatively downbeat for the emerging market complex as a whole. But I think it's very important to disaggregate that emerging market complex. The IMF does a very good job of this. The IMF breaks down the impacts on emerging market complex depending on why we're seeing the changes come through. It has very different results for emerging markets if the Fed's reaction function has changed, or if we see a supply shock coming through, or if this is a demand shock. So differences in reasons for these changes can sometimes come through as well, and it's why we at AXA Investment Managers spend a lot of time disaggregating and looking at the precise history. And the chart, the very colourful chart that we have on my left-hand side, illustrates how different shocks impact different economies in different ways. So the red showing that there is a very extreme shock, the green showing a more benign backdrop from different interest rate adjustments. And as you can see, the emerging market complex, as I'm sure we all are aware, responds actually in a very heterogeneous manner. We do see very different reactions coming through. And when it comes to Mexico, that's a very important story, because at the moment the Mexican economy outlook is very positive. What we see coming through here, I mean, the US-Mexican relationship has always been a very positive one. The Mexican economy has always benefited from spillovers, if you like, from a strong US economy. And that's coming through as well. And we can see that this time around in the relationship between Mexican growth, Mexican economic activity, and the US 10-year yield that we plot here. Because here there's a positive relationship. We don't see a story where higher interest rates in the States are actually clamping down on Mexican growth, quite the reverse. When US Treasury yields are strong, we tend to see strong Mexican growth. And that's precisely because US Treasury yields are strong when the US economy is strong. And when the US economy is strong, it has a positive boost to the Mexican economy. So from that side of things, the strength and the economic resilience that we've seen in the US and the plausible strength that we see going further forwards is a definite plus for the Mexican economy and not something that should be seen as a headwind. The dollar side is slightly different. The dollar has always posed some challenges, and historically we have seen that when the peso weakens, it does create problems for inflation. With something of a lag. I think the difference this time is that the Mexican Central Bank has been very aggressive on the front foot of this, and has therefore meant that real interest rates in Mexico have kept relatively solid. Now that actually has something of a headwind to economic activity itself, but it's kept a relatively good handle on inflation, and inflation in Mexico is obviously coming down. It's very close to coming back within the range. It's certainly something that we think will be within the range of the Mexican Central Bank's zone of tolerance over the next year or so. So we still see these cyclical pressures coming through, but we argue that for Mexico, even cyclically, this resilience that we're seeing from the US is important. But I think there's another important story that's emerging as we come through here, and that's an acyclical story. It's a new story, and it's the story of nearshoring and the realignment of global supply chains. And I know I'm not the first person that's brought this up already in this conference, and I'm certainly not going to be the last person that talks about that realignment. But what we're seeing is over the last since 2018, over the last 5 years, we've seen a material drop in the amount of imports that the US buys from China. Now, when you look at the breakdown of where that goes, it's split amongst a number of countries. Obviously, the EM Asia gambit as a whole is picking up quite a material amount of that, nearly 3 percentage points. And it's not obvious with that whether that's third-party firms that are setting up in emerging market Asia as a competitor, or whether or not it's Chinese firms re-establishing sort of links through there. Nevertheless, there's been some displacement into emerging market Asia, and other areas of the world have also gathered. But we're seeing significant increases in both Mexican imports into the US and Canadian imports into the US, and that's something that we think is likely to continue. Now, when we also consider the pickup coming through from foreign direct investment, we can also see that the US, even in pure terms, so this doesn't take account of the size of the economies, just looks at pure dollar terms of how much foreign direct investment the US is putting into different countries, we can see a clear pickup in US foreign direct investment into Mexico. And that clearly is bolstering some of the supply chain potential coming through there. So this again is something that comes through above the cyclical story. So we're arguing that there is a cyclical boost that's going to remain to Mexico, but over and above that, and that means over the next 5 to 10 years, there seems to be this strong resource of resupply chain indexing coming through as well. So I'm mindful that it'll be useful to sort of hear your questions, hear your observations about any of and all of what I've said, but let me just wrap up quickly before that. What I'm trying to explain is why we're seeing this large pickup come through in US Treasury yields. In part, it's because we've seen an economy that's more resilient to Fed tightening than has been the case before, and because it's desynchronized the slowdown, we think it is now likely to avoid recession, is now likely to be something more like we saw in the 90s, a period of persistent growth rather than falling into recession. And that has marked implications, not for where the Fed's peak rate is, but for how quickly the Fed can cut rates over the next couple of years. And that expectation has been reduced, but also where interest rates are going to settle after that. And I think market expectations are for those rates to have risen as well. So that creates quite a powerful macro story as to why rates should be higher. At the same time, there are technical features that are also boosting rates higher. Break-even inflation expectations are moving back to where they should be, having been somewhat subdued over the last decade, and term premia is starting to re-emerge and will play a bigger part of the full compensation of US Treasury yields over the next few years. So all of those factors are leading to quite a strong pickup in US yields, albeit that we think US Treasury yields are pretty much around their peak at the moment. That is also creating quite some pressure for the dollar, because this is an exceptional strength coming through from the US. So whether we compare it to the Eurozone, which we're arguing is weaker economically and sees softer investment trends, or whether we compare it to the broader EM space, then this pickup in higher yields, this pickup in the dollar is going to create something of a headwind for those economies. But we have to be quite diligent in looking into the emerging market space to see what different effects higher interest rates and higher dollar have for different economies. For some, they will prove a significant headwind. We're already seeing central banks in, for example, Latin America that had been pretty dovish, that seem to now be a little bit more cautious in how many more rate cuts they're going to put through. Looking a little further afield, the Indonesian central bank hiked rates, having been on hold for the last 7 months. So already there's some change coming through in central bank policy, but we have to look quite diligently at the differences between the two. And what we argue is that for the Mexican economy, the US strength is cyclically quite supportive, and the fact that we don't see a recession emerging in the US should therefore mean there's no great headwind to Mexican growth in the near future. But more importantly, a realignment of global supply chains, and more importantly, US supply chains, is something that's increasingly supportive and is likely to be a key driver of Mexican growth over a longer period of time. So, with that, I'll sit down. I'm very happy to go through any of that in any more detail, or any other broader questions that we might have.
So thank you very much, David. Very interesting, and as always, great challenges ahead. So we actually don't have much time, so let me just rephrase a couple of questions for you before we end the panel. So you touch upon investment, you touch upon productivity, and one of the key reasons why structurally rates are going to be high, right? So what does this actually mean for capital deployment itself, right? How capital flows, especially in real assets, how history tell us that should actually react to this new framework?
Well, I think the exciting thing from a global perspective is that we're at the cusp of quite a few trends in investment starting to come together. So if we think about it from a US context, we've seen the CHIPS Act, which is obviously there to design semiconductor resilience, and the Inflation Reduction Act, which despite the name is basically there to try and support green transitioning. And both of those have already led to significant increase in commitments of investment and already some investment coming further forwards. I've not mentioned we've also got a lot of investment going into AI as well. So there are different streams of investment coming together. Now at the moment, the majority of that investment looks like it's going into the physical investment. So we're seeing a lot of manufacturing structures starting to pick up. But if we think about the lag of that, those manufacturing structures should then lead to capital equipment to fill those manufacturing structures. And when you've got the equipment and you've got the structures, then you need the labor. So over the next couple of years, we would expect to see US economic performance start to increase as the US manufacturing hub itself grows. But it's that driver that is also building across the whole of the USMCA hub as well. And that's part of the spillover effect.
Yeah, that's great. So we are out of time, but then again, so last question, what worries you? What are the risks to all the economic outlook you just framed out?
I mean, short term and long term. Short term, I think we all need to keep our eyes very closely on the geopolitical scene. You know, we've been watching Russia-Ukraine for nearly a year or more now, but obviously the recent shocking events in the Middle East are also something that could very quickly escalate, and that's something that's just very difficult to keep an eye on. So we monitor that. That's a distinct risk. Over the longer term, I think it has to be climate change. I mean, there's a lot of investment that's going into trying to avoid some of the worst impacts of that. But at the path the global economy is on at the moment, we're on a 3 to 4 degree increase in global temperatures by the end of this decade. That basically means anything south of London is going to get increasingly difficult to live in. And that's a huge impact on most of the world. So this, I think, is still the number one issue for the longer term. But very clearly, there are some short-term worries in there as well.
That's great. Couldn't agree more. So, David, on behalf of Afore, thank you very much for being here.
Much.
Thank you.
Thank you. Cheers.